So if you are anything like me, you are busy. I mean, you want to get straight to the core of a complex topic. You want the multiple perspectives, and you really want those aha moments, right? But you want them without having to drown in a 100-page PDF to get there.
Oh, absolutely. Nobody has time for that, yeah.
Right. And usually, when we look at a piece of consumer technology, there is this underlying expectation of just, well, total simplicity.
Mm.
You pull the latest iPhone out of the box, and it's just this perfect, seamless rectangle of glass and titanium.
Right, it feels like magic.
Exactly. It
Well-
feels like it just magically appeared out of thin air.
Well, I mean, that's by design, right? It is entirely designed to hide the immense complexity of, how it actually got there.
Yeah, but if you were to somehow take that iPhone and, put it under a geopolitical X-ray machine, suddenly you aren't really looking at a phone anymore. You are looking at this highly sensitive, highly localized map of global fault lines.
That is a fantastic way to put it.
And today, for you listening, we are going to look at this massive company through a totally different lens. Because I think when most people think of Apple, they just think of, product launches, the App Store, maybe those crazy lines around the block. But the reality behind the curtain is infinitely more complicated.
It is, yeah. I mean, it is the absolute definition of an industrial tightrope walk right now.
Totally.
Yeah.
So today's deep dive is based on a really fascinating analytical report by Fabio de Jesus Suarez Agudelo. It's this deep, really granular look at Apple's fundamentals and specifically its geopolitical risks.
Right.
And our mission today is to sort of figure out why the world's most famous tech giant is suddenly trading as much on global politics and supply chain geography as it does on whatever new camera feature they just announced. I mean, we are living in this era of global fragmentation, and Apple is just right in the crosshairs.
They really are. But, to really grasp those risks, to understand why the financial markets are watching Apple's geographic footprint so incredibly closely, we first have to understand the underlying engine of Apple's wealth.
Right, the mechanics.
Exactly. You cannot truly understand the threat until you understand the mechanics of the machine that is being threatened.
Let's start right there then, because before we zoom out to all the geopolitical drama, I want to establish the actual math of how Apple makes its money and sustains that massive stock price.
Yeah, the math is key.
The report lays this out beautifully, by the way. It essentially describes this twin-engine system, and it's backed up by a very specific financial shield. Because, honestly, I always assumed they just, sold a lot of phones and got rich. But it's much more structured than that.
Oh, the structure is everything. It's very deliberate.
Right.
So the first engine, and look, this won't surprise anyone, is the iPhone itself. It is the primary hardware asset, and it generates roughly half of Apple's total revenue.
Half. I mean, just think about the scale of that for a second.
It's massive.
One single device is the motor of their entire global demand.
And because it is that primary motor, the production costs of the iPhone act as the main catalyst for Apple's short-term stock price. If it costs them even slightly more to source materials or assemble the physical phone, the financial markets react immediately.
Because it hits the bottom line right away.
Exactly. But there is an inherent flaw in relying solely on hardware. I mean, hardware sales are highly cyclical. Consumers don't buy a new $1,000 phone every month.
Right. Definitely not anymore.
Right. They hold on to them for 3, maybe 4 years now. So you get these massive revenue peaks during the holiday launch season, followed by these really deep valleys.
Which brings us to the second engine, right? The
Yeah.
services division. We are talking about the App Store, iCloud subscriptions, Apple Pay, Apple TV Plus. And here is where the mechanics get absolutely fascinating to me. The report points out that this division operates at massive gross margins. We are talking over 70%.
Yeah, that 70% figure is the lifeblood of the modern company. It really is.
It's unbelievable.
What that means, practically speaking, is that for every dollar Apple makes in services, it keeps 70 cents after the direct costs of delivering that service.
Wow.
Now, compare that to the physical phone. To make a phone, you have to mine raw metals, ship them across the world, run these incredibly complex assembly lines, put the finished product on cargo ships, store it in physical warehouses.
The overhead is just wild.
The costs are immense. But to sell an extra 50 gigabytes of iCloud storage, or to take a cut of a digital App Store purchase, you are essentially just flipping a digital switch. The infrastructure is already built, so the margins are astronomically high.
Reading this, it makes me think of a blockbuster movie franchise.
Oh, so?
Well, if you look at the business model, the iPhone is sort of like the massive, incredibly expensive summer blockbuster movie. Like, it costs an absolute fortune to make, it takes years of physical production, and it drives millions of people into the theater.
Right, gets them in the door.
Exactly. But the services division,
Yeah.
that is, the theater concessions and the monthly streaming subscriptions, it's the popcorn and the soda. I mean, the margins on popcorn are huge, and that is what actually keeps the studio rich all year round, even when the movie isn't playing.
That is a perfect way to visualize it. It really is. Services provide this crucial, highly stable cash flow. It acts as a massive shock absorber for the company when those hardware sales go through their natural cyclical dips.
And then there is the financial shield I mentioned earlier, the capital return policy.
Right, the buybacks.
Yeah, the report details how Apple uses its massive cash piles for stock buybacks and dividends. And I see the term stock buybacks in the financial news all the time, but walk me through the actual mechanics. How does a company buying its own stock actually help the remaining investors?
It comes down to basic math and supply, really. When a company buys back its own shares, it takes those shares off the open market and just retires them.
Okay.
So it permanently reduces the total number of outstanding shares available in the world.
So, if I'm understanding this correctly, if the total profit of the company stays exactly the same year over year, but there are fewer shares in existence to claim that profit.
Then the earnings per share, or EPS, artificially goes up.
No, I see.
Think of the company's total profit as a pizza. The pizza hasn't actually gotten any bigger, but by buying back stock, Apple has essentially sliced the exact same pizza into fewer pieces. So mathematically, every piece that is left over is larger and more valuable.
That makes total sense.
And this provides a sustained sort of technical baseline of support to the stock price, regardless of what the broader market is doing.
Okay, so we have this perfectly balanced, beautifully engineered financial machine. You have the blockbuster hardware driving people into the ecosystem, the digital concessions printing high-margin cash to stabilize the slow months, and the buybacks constantly shrinking the pie to prop up the share value.
It's brilliant.
It is. But if this system is so flawless, why is the stock market suddenly so jittery about them right now?
Because a brilliant financial model does not make a company immune to geography.
Ah,
My map.
yes. All of those pristine spreadsheets and margin calculations rely on a messy physical reality. And that physical reality is currently caught in a geopolitical vice.
Man, this shifts our whole perspective from the internal math to the external map. And looking at that map, China seems to be this incredibly complicated double-edged sword for them.
Uniquely complicated. I mean, China is not just a factory for Apple. According to the analysis, China represents somewhere between 15 and 20% of Apple's total global revenue.
That is a massive chunk of change.
It is a vital, massive market of incredibly eager consumers.
But at the very same time, it is the historical epicenter of their physical assembly line.
Yeah.
So you have the ongoing U.S.-China trade war just like hanging over this deeply intertwined relationship.
Exactly. Trade policies or retaliatory tariffs between the U.S. and China, they aren't just abstract political headlines anymore. They are direct threats to those hardware production costs we just talked about.
Okay, I want to pause on this tariff issue for a second because the mechanics often get a little fuzzy in the news.
Yeah. Let's say a massive tariff is suddenly slapped on an iPhone that is assembled overseas and imported into the U.S.
Mm-hmm.
From a purely practical standpoint, who actually writes the check for that? I mean, does Apple just eat the cost out of their massive cash reserves? Or do I, the consumer, end up paying more at the checkout counter?
That is the exact brutal binary choice the report highlights. And the problem is, both options break the financial machine we just discussed.
Okay, lay it out for me.
So option one, Apple absorbs the cost of the tariff. If they do that, they are paying the tax out of their own pocket, which directly reduces their profit margins on the hardware. It eats right into the engine.
And Wall Street punishes margin compression instantly.
Instantly. It shows the company is losing its profitability. So they look at option two. They pass the cost along to you, the consumer. They just raise the retail price of the iPhone to cover the tariff.
But if they do that, they risk massive demand destruction. I mean, if an iPhone suddenly costs $300 more, a lot of people might just decide to hold on to their old phone for a fifth year, right? And then the blockbuster movie engine slows down.
It is a lose-lose scenario forced entirely by geopolitical friction. And tariffs aren't even the only risk in China.
Right, there's more.
The report also heavily notes the regulatory and operational environment. If the Chinese government decides to implement, say, sudden bans on the use of certain foreign devices for state employees, or puts new restrictions in place, it creates immediate, tangible drops in Apple's valuation.
Because suddenly, That 15 to 20% chunk of global revenue is in jeopardy. And there is literally nothing Apple's engineers can do about it.
Nothing at all.
But as tense as the situation in China is, the report highlights a different geographical choke point that is arguably even more alarming.
Taiwan.
Right. Because as much as we think of Apple as a hardware company, they don't actually manufacture their own most advanced semiconductors.
No, they don't.
They design the architecture of the chips in California, sure, but the physical, microscopic manufacturing depends almost entirely on one single company, TSMC, the Taiwan Semiconductor Manufacturing Company.
And this is what economists and risk analysts call a systemic risk.
Meaning what exactly?
It means the entire global system is vulnerable to a single point of failure. TSMC's manufacturing capabilities are so advanced and honestly so specialized that they cannot be easily replicated anywhere else on the planet, not even by Apple.
Wow.
So any geopolitical escalation in the Taiwan Strait doesn't just disrupt Apple's supply chain, it effectively halts the production of the brain of the iPhone.
And obviously, you cannot sell a $1,000 piece of glass without a brain inside it.
You really cannot. And the financial markets are acutely aware of this bottleneck. They are actively pricing this geopolitical risk into Apple's stock right now.
The report mentions volatility premiums, right?
Yes, exactly. Investors are demanding a premium or like a higher potential return to justify holding the stock because the uncertainty regarding the Taiwan Strait is so profound.
It is just wild to realize that when you buy a share of Apple or even just buy an iPhone, you are implicitly betting on the ongoing stability of the Taiwan Strait.
You really are.
So if your main factory and your most important supplier are sitting right on top of this massive geopolitical fault line, the logical, obvious next step is to pack up and move.
You
Diversify.
Which is exactly what they are attempting, with the strategy widely known as China Plus One.
Right.
It is the strategic initiative to maintain operations in China because, you still want to sell to that 20% of the market while simultaneously building up massive manufacturing hubs in at least one other country to mitigate the risks we just covered.
And the report specifically calls out India and Vietnam as the primary targets for this physical diversification. Apple is aggressively accelerating its footprint in these countries. But the friction here is that the transition is painfully, agonizingly slow.
It is. The analysis notes that while iPhone production in India has grown noticeably over the last few years, it is hitting some very strict limits. Right now, reaching a 20 to 25% share of global production in India seems to be a hard ceiling that they are really struggling to break through.
I think people often assume that moving manufacturing is just a matter of signing a commercial lease on a new, bigger warehouse somewhere else.
Oh, if only it were that simple.
Right. But reading this report, moving this specific supply chain sounds less like opening a new factory and more like trying to move an entire bustling city brick by brick while millions of people are still living in it and demanding services.
That is a phenomenal way to frame it. You aren't just moving the final assembly line where the screen is glued on. You are having to relocate an entire deeply integrated ecosystem.
So walk me through the mechanics of that. Why is that 20 to 25% mark in India such a hard ceiling right now? Like, what is physically stopping a company with virtually infinite money from just pushing production to 50% tomorrow?
Well, it comes down to three major, highly physical roadblocks identified in the report. First, a severe shortage of localized suppliers. See, Apple relies on just-in-time manufacturing. In China, if an assembly line suddenly needs 1,000 specialized screws or a specific titanium housing component, the factory that manufactures those parts is likely right down the road. They can have them there in an hour.
That's incredibly efficient.
Very. But in India, that deep, localized, hyper-efficient supplier network does not fully exist yet.
Ah, so you have the final assembly line built, but you don't have the lumber yard or the hardware store nearby. You have to import the tiny components across an ocean just to put them together, which completely breaks the speed of just-in-time manufacturing.
Precisely. A delay on a single 2-cent screw can halt a billion-dollar assembly line.
That is wild.
The second roadblock is deficient infrastructure. The roads, the deep water ports, the power grids, they need to be flawless and entirely reliable to support Apple's incredible volume.
Right, you can't have blackouts.
Exactly. In many emerging manufacturing hubs, that infrastructure is still developing. A power fluctuation or a traffic jam at a port cascades through the entire supply chain.
What's the third roadblock?
Third is bureaucratic red tape. navigating a completely new regulatory environment, acquiring land permits, dealing with local and regional governments. It introduces massive friction into a system that relies on total smoothness.
And as we know, in business and logistics, friction always equals cost.
Always.
Which brings up a term the report uses heavily, CapEx,
Well, sex.
capital expenditure.
Yeah.
Just to sort of integrate this for everyone listening, when we talk about CapEx in this context, we aren't talking about abstract operating costs. We mean Apple's actually taking cash out of the bank to buy the physical land, pour the thousands of tons of concrete, and literally build the power grids and factories from scratch. Right?
Yes, exactly. Reconfiguring a global supply chain requires billions of dollars in CapEx, and making these massive upfront physical investments severely pressures Apple's short and medium-term operational costs.
I can imagine.
Think about it. They are spending mountains of cash to build up this new city in India and Vietnam, but they haven't yet achieved the massive economies of scale and efficiency they spent the last 2 decades perfecting in China.
So they're essentially subsidizing a brand new, highly inefficient system, all while trying to maintain their old system.
Yes, they are bleeding cash on the setup long before they can reap the rewards of the efficiency.
Man. So we've talked extensively about the physical threats, the hardware, the shipping lanes, the tariffs, the concrete. Let's look at the other side of the coin. Because up until now, we've entirely ignored the crown jewel we discussed at the very beginning.
Right, the services division, the 70% margin.
Right. As we established, services is the high-margin digital safety net that absorbs the shocks of everything we just talked about. But now, according to the report, that digital fortress is under direct attack by international regulators.
It is. Geopolitics used to just be about physical borders and physical trade routes. What is fascinating here is that the geopolitical risk has shifted to digital borders.
How so?
Regulators across the globe are aggressively trying to dismantle Apple's notoriously closed, highly controlled digital ecosystem.
Yeah, the report points to two massive regulatory fronts that are happening simultaneously. First, across the Atlantic, you have the European Union's Digital Markets Act, widely known as the DMA. How does this act physically change the way the iPhone works in Europe?
The DMA is a fundamental paradigm shift for Apple. It is legally forcing the company to open up its notoriously walled garden in Europe. Historically, Apple has controlled everything on the device. Now they're being forced to allow third-party app stores to be installed on the iPhone.
Meaning developers can bypass the official Apple App Store entirely?
Yes. And more importantly, it means allowing alternative payment processing methods.
Ah, there it is.
Yeah. Apple historically collects a standard 30% commission on almost every transaction inside an app. That commission is a huge part of that 70% gross margin we marveled at earlier.
It's the toll booth?
Exactly. The DMA is essentially forcibly dismantling Apple's proprietary toll booth.
And it isn't just Europe taking a swing. Back in the United States, the report highlights actions by the Department of Justice. The DOJ is pursuing massive antitrust lawsuits against Apple, specifically targeting its monopolistic control over the iOS ecosystem and those very same App Store commissions.
It is a coordinated, multi-front attack on the company's most profitable revenue stream.
So let's connect all of this back to the core mechanics. We started this deep dive by establishing that the services division is the ultimate safety net. It is the shock absorber that protects the company's valuation when hardware costs fluctuate due to things like tariffs, or when they have to spend billions in CapEx to move a supply chain to India.
Right.
If regulators in both the EU and the US are actively taking a sledgehammer to that exact safety net, what does this mean for the company's fundamental value moving forward?
It introduces a layer of profound, unprecedented uncertainty. The analysis makes it remarkably clear. These regulatory attacks are targeting the most crucial defense mechanism the firm has. If the massive margins on services are forcibly compressed by international legislation, Apple loses its ability to easily pay for the physical supply chain chaos we discussed earlier.
It's the ultimate pincer movement. You have immense pressure on the physical hardware costs from the geopolitical map and immense pressure on the digital profits from global regulators, all happening at the exact same time.
Which brings us to the ultimate synthesis of Fabio de Jesus Suarez Agudelo's analysis. If we connect all these disparate dots, the twin financial engines, the threat of tariffs, the systemic risk of Taiwan, the billions spent moving to India, and the regulatory assault on the walled garden, the main takeaway is that the behavior of Apple stock has fundamentally, permanently changed.
It really reframes how you look at the daily market. I mean, the stock price is no longer just a reflection of product launch cycles. The market isn't just waiting to see how many megapixels the next camera has or what new color the titanium comes in.
Not at all. Today, the valuation of Apple is a real-time, daily referendum on a company trying to navigate an era of intense geoeconomic fragmentation. It is a real-time tracker of their ability to survive a globalized world that is rapidly pulling itself apart.
But they aren't completely defenseless, right? I mean, the report does offer some significant counterweights.
Yes, absolutely. The analysis points out that despite these immense headwinds, Apple still possesses unparalleled pricing power in the high-end consumer market.
People still want the phone.
Exactly. Despite the risks, people will still line up and pay a premium for an iPhone. And their services division, even under intense regulatory scrutiny and forced changes, continues to grow in overall volume, providing a massive financial cushion. These are their remaining shock absorbers.
But the ultimate conclusion of the report is that their future valuation premium-like, how much better they perform compared to the rest of the market, depends almost entirely on their speed.
Speed is everything here.
It depends on exactly how fast they can decouple their physical supply chain from these high-risk geopolitical areas before the digital margins compress too much.
It is a high-stakes race against both time and geography.
It really is. And that leaves us with something I want you, the listener, to mull over as we wrap up today's deep dive into this report. We've just spent the last chunk of time dissecting how Apple is trying to survive this global fragmentation. We are talking about an absolute behemoth,
The biggest of the big.
a company with virtually infinite resources, a CapEx budget larger than the GDP of some countries, and the kind of consumer pricing power most businesses can only dream of. And even they are struggling to reconfigure their supply chain. Even they are hitting hard ceilings in India and battling regulators on multiple continents.
It raises a really profound question about the future of the rest of the technology industry.
Exactly. If a titan like Apple is finding it this difficult and this expensive to build a functioning China plus one strategy, what does that mean for the thousands of smaller tech companies out there?
Right, the ones who don't have that kind of cash.
Yeah. The companies that don't have billions of dollars in cash lying around to build new, redundant supply chains in emerging markets. Are we rapidly heading toward a future where only the absolute richest, most heavily capitalized companies on Earth can even afford to manufacture hardware on a global scale?
It is a very sobering thought. The sheer financial cost of entry to participate in global tech manufacturing might be getting prohibitively expensive for anyone who isn't already a giant.
It really brings us back to where we started. The next time you pick up your phone and you look at that seamless, perfect rectangle of glass, just remember what is really inside it. You aren't just holding a piece of consumer technology. You are holding a highly localized map of the world's geopolitical fault lines. And right now, those fault lines are shifting violently beneath our feet.